and welcome here in Amsterdam. It is, what time is it? It is 3 p.m. 3:30 p.m. This is the second webinar of the 2Tokens Summit, and I'm filling in here as moderator for Olivier Rikke. My name is Alex Bausch. I am the chairman of the 2Token Foundation, and it is my honor to welcome you to this session, this deep dive session on regulations and MiCAr. We are not doing this session alone. We have a corona-proof, COVID-19-proof table here with 1.5 meters distance between all of us. And we have 4 people in the room. And let me introduce you to the person on my left, the captain of the 2 use case and part of our foundation's board, Jelle Pol.
Thank you. Yes, I'm Jelle Pol. Co-founder at the DAS Network and also technology director for the 2Tokens Foundation, here today to talk about tokenization in Europe's financial markets.
My name is Willem-Jan Smits. I'm a lawyer specializing in Bitcoin, blockchain and tokenization. I offer services to a broad base of clients on the first regulation now, implemented in the Netherlands. And from that perspective, I'm really interested, and I'm going to talk about with these guys on the MiCAr regulation as well as other regulation aspects of EU capital markets.
That's right. And if you want to know more about Willem-Jan, go to What's on Law. So,
thank you.
And to my right is Dion. Dion has also been in this masterclass series this week, this month, this summer.
This summer, yes.
So for those of you who missed you, please introduce yourself.
I'm Dion Bongaerts, Associate Professor of Finance at Rotterdam School of Management, Erasmus University. Associate Professor there and also Academic Director in the FinTech area of expertise in the Erasmus Center for Data Analytics.
Good. So today we have a full agenda. It's actually a very interesting deep dive session because what we are going to be discussing here with these experts is what was published 2 weeks ago. And for those of you who are on Politico, you could have seen it earlier. But it's the MiCAr, and we had a discussion here. Is it MiCAr or MiCAr? But according to the guy who knows, it's MiCAr because it stands for MiCAR regulation. And so today's agenda, we will be talking about tokenization in Europe and how the European Union and the MiCAR regulation, this markets in crypto assets, perceive this. So why don't you take it away, Jelle?
Yeah, so it's really important to note if we take one step back, right, we're at the 2Tokens Summit, ecosystem initiative for the Netherlands, and one of the big things that sets kind of our initiative apart is there's a strong use case focus, right? So it's not only policy making or creating frameworks, we're also really trying to apply our learnings and the things that we work with and try to bring it into practice, right? So today's session where we're looking at tokenization in Europe's financial markets, we will be going through some of those frameworks, but also really trying to apply it to some use cases. So we have 2 use cases lined up that are also relevant for our wider agenda, namely the European securities market, so that's really kind of the asset side of the picture, and CBDC, which is another 2Tokens working group, which focuses on at least the potentials of kind of the cash side of the equation. So we'll be going a little bit through what's the landscape like, what have we seen in headlines recently, what's the relevant background knowledge, and then how can we start applying this, and where is essentially the profit or the benefits or societal change, you name it, to be made. So,
and let's not forget that today is a marathon, right? You and I, we will be in this until 10 o'clock this evening. Yeah. This is the second deep dive session. The first one was all about the token roadmap, where we were looking at what steps need to be taken to apply tokens. But today is deeper than that, right? So why don't you elaborate?
Yeah, so it's very much a deep dive. Alex is moderating, so he'll be taking care of chat. So people feel free to ask your questions throughout. And if Alex deems them of high enough quality, then they should reach us. But yeah, let's dive into the state of the landscape today. So when we look at tokenization today, we have a few big developments and a few headlines that we wanted to touch upon. I'll take care of the first one. So one thing that we saw in the news 2 days was McAfee getting arrested. John McAfee, known as the originally as the antivirus king in the United States, was arrested in Spain for a slightly convoluted case, if you will, because it's really about two things. And the first one is the kind of main charge on which the United States are kind of demanding extradition, which is about tax evasion. It's a case by the American IRS and his failure to file a revenue. And the second one, and that's a little bit more interesting towards our topics of today, is an SEC complaint, so the United States securities regulator, which focuses on undisclosed compensation and materially false and misleading recommendations. And this is all very much in the light of the ICO advertising that John McAfee was a part of 2, 3, 4 years ago, where he reportedly made $23 million. And the SEC are saying this is under false pretenses, largely, that this money was made. This is not the main charge, but it is the most relevant item to what we're seeing right now in Europe, which is a increase in regulatory frameworks in our space, under which also items like the McAfee case should be dealt with, or at least they're trying to clean up kind of that more shady part of the scene, if you will. So we saw this framework launch recently. Maybe Willem-Jan, you can briefly introduce MiCAr?
Yes, we have a regulation that is coming out in Europe regarding markets for crypto assets. And really briefly, a crypto asset is a digital representation of value on a blockchain. So that's a really, really broad definition. And there's some further downtoning on that for other types of crypto assets. We will dive into that a bit later. But it also regulates service providers like exchanges, fiat on-ramps, as well as it's a regulation for market abuse, which is the bridge to the McAfee case. So this is basically what we know for normal financial instruments. You have a couple of directives, and the MiCAr is all in one, so to say.
So for those of you who are interested, the 2Tokens Foundation published a piece, an opinion on the MiCAr Foundation 2 days after it was published. Many of our members, according Dion, and helped write that first opinion. You can find it in our podcast and in our blog section if you're interested.
Yeah, very good. And one of the key things that we also saw in the securities market, which is what we'll be talking about today, is that security tokens, although they are DLT implementations, have been clearly put under the MiFID II framework, so the existing regulatory framework.
Yeah, they were already obviously under MiFID II, but they're expressly exempt from MiCAR, so there's no double regulation there.
And one interesting point is that it also includes derivatives, which are not only derivatives on securities, but also on utilities, right, which can be under MiCAr.
Yeah, the underlying itself is under MiCAR, but the derivatives on top of that, they're regulated as a financial instrument and thus under MiFID.
Yeah, exactly, and that will start bringing up some potentially interesting edge cases as well in how some of these frameworks are going to be applied. Some of the other things that were relatively important this year is that we saw a big DeFi hype. Depending on who you ask, it's a bubble or it's the next big thing. It is already lying down again a little bit. It's a weird market, and we are seeing a resurgence a little bit again of the non-fungible tokens, so the NFT standards. They've kind of had a few small waves, if you will, but not really broken through as a kind of a year-defining concept yet. How are you seeing that in the market, Willem-Jan?
I see it, people talking about it, and some initiatives there, and some predictions that it will be the next big thing after DeFi, but no real implementation yet. And one thing is interesting to name is that non-fungible tokens are explicitly exempt as well from the MiCAR regime.
Yeah, and in a wider sense, this pertains to the DeFi hype, but also, I guess, the global capital markets. It's been a very irrational year on the stock markets in general. We obviously had our pandemic, which is still ongoing, which has, well, impacted global markets, but not necessarily according to the logical predictions, right? We might have been expecting a way different market now. And one of the things that crypto has always been touting is their kind of non-correlation narrative, right? So crypto is a different kind of asset. It's a diversification. It's something that you hedge against the world as is with.
You also see that in data.
Yeah. And
at least historically.
You do see it in data. And one of the interesting things is now it's really had its moment, so to say, right? Also during COVID. But we also see that it is still not as non-correlated as they perhaps would like, because the stock markets have also still been, well, potentially artificially, still been doing quite well. Do you have views on this correlation, or what does the data say, Dion?
The most recent one, I don't exactly know, because we only have seen a very short short period, and in different markets also government stepped in. Yep. That makes it very hard to see what's really going on fundamentally. So I don't have a very clear view on that.
Understandable. There's all these also the traditional support funds that have impact on the normal capital markets, etc., which make it a muddy comparison at best.
Yeah, the regular equity market is now very hard to know what is expectation of about government response and what is expectation about fundamentals. Yeah,
exactly. The delay between the stock exchanges and also what we will be seeing in the real economy, right? Our day-to-day lives.
Yeah, but also the very important role that the government now plays in regular securities markets, as opposed to crypto markets, where the government is not taking much of an action in terms of trying to stabilize or so.
But there are indicators for non-correlation. So is that crypto market then taking things into their own hands? Well, which I guess historically always have, or are they following the government-backed cycluses of a stock exchange?
At the moment, I don't have the...
No worries. One of the other big things that we've been seeing, or at least something that I've really been seeing in my part of the space, that traditional and crypto exchanges are converging. We've always kind of been of the mind that over time the crypto market and the traditional financial market will become just the financial market again, right? This will take some time. We're seeing a lot of the big traditional stock exchanges, Australia, London, Germany, custodians in the US, really moving into security tokens. And we're also, at least behind the curtain, seeing a lot of crypto exchanges kind of spreading their wings into the securities domain. Perhaps the final point, which we'll also touch upon in our discussion later, is the kind of various forms of DLT cash, if you will, or cash-like instruments, Tether versus central bank digital currencies versus Libra. How do you see this playing field, Willem-Jan?
Yeah, from a regulatory perspective, it's really interesting because MiCAr will cover most of those. Of course, not the CBDCs, because there will be governmental issued by central banks.
They're explicitly exempt, right?
They're explicitly exempt, yeah, as in most of the financial regulation. Member states themselves and central banks, etc., are exempt. So also in this regulation. But all the other initiatives, if they focus on the EU market, they will fall under the MiCAr regime.
Yeah, indeed, and probably on that note, good to just move into that. So at a very high level, what do we see in the MiCAr regime, or where will it really impact crypto as we knew it yesterday and crypto as we will know it post-MiCAr?
Yeah, it's all EU perspective, of course. But since the definition of a crypto asset is so wide, it will basically cover everything that of most things that we know in crypto markets, starting with the digital representation of value as the broad definition, and under this we have more specifically the utility token, which is a term that we are all familiar with, I guess, but it's a token that can be spent in a network for a service or a product, mostly digital. Issuers of that will be required to draw up a prospectus like thing. It's called a white paper. It's not as elaborate as a prospectus, but an information document. Then we have the asset referenced token, can be seen as a stable coin, basically either reference to a basket of assets or fiat currency. And there's a distinction between a normal one and a significant one being with significant impact on the financial markets. Yeah. And the same goes for e-money tokens. That's the third basket, so to say, of regulated tokens. And that's actually e-money. And there's where it gets interesting, because those institutions, issuers of those tokens, will in Europe be obliged to have a permit as an e-money institution. So that's a bit of a crossover, so to say. Yeah. And outside of this whole spectrum, we have the traditional cryptocurrencies like Bitcoin, Ethereum, and they fall out of the three types of tokens I just mentioned, but of course inside the
so these are exempt?
No, they're not exempt. They fall inside the virtual, the crypto asset category. So if you provide service on top of them, like exchange, like advice, then you, as a service provider, will be required to authorize.
And have they kind of made this, well, not exemption from the framework, but they've been placed outside the baskets? Is it because they were there since the beginning and they're too big to force into a classification, or is it something bigger?
I think it's and we'll go on to that a bit later, but it's based on the typical standards that you see. Yeah. So those standards are regulated, and as a broader thing, services regarding the other tokens are regulated as well.
But practically this means that, for example, if an exchange operates in Europe and they have Bitcoin trading pairs, for example, then they will fall under this regulation, right? So that's definitely a very, very practical example of how probably a lot of service providers, some potentially even unknowingly or because they're servicing in the European market, will now have to adhere to this framework.
Yeah, that's correct.
But they need to actively approach European citizens, right, in order to fall under this.
That's correct. This is with all this type of regulation. You also see it with AML regulation, which applies now in Europe and also in the Netherlands. But also with gaming regulation. If you aim actively at the market, then this regulation applies to you, no matter where you are situated yourself.
So, but MiCAr will be overarching, but every country in Europe can still impose their own regulations?
No. It's a regulation, which means that it directly applies to all the member states.
All right.
There's a distinction between...
It's not a directive, but
a directive, exactly, that needs to be implemented in the member states, like AML D5, Directive 5. This will be a regulation which directly applies to the member states.
But on that last subject, there are some interpretations, that countries can take.
Mm-hmm.
Right? So,
but in a regulation, they need to be... in the regulation itself, the points that can be interpreted, and with a directive that should be implemented in national law.
So let's take this into an example. Sorry, because I'm not...
So one good example, indeed. I also want to see if we can, as much as we can, bring it back to examples. So you talked about utility tokens earlier. So previously, everybody could kind of write their own white paper, and it was in the interest of the project to make this as good as possible document, because you want to have a successful fundraise, or you want to emit a certain kind of trustworthiness or capability. But now these white papers have to be actively approved by the national banks or regulators, right? So they can be denied, basically.
There's a slight distinction. For utility tokens, you need to notify the regulator. Right. So, and they don't have to approve it, but they can force you to make changes.
Right.
So, and there's obviously in the regulation are some points that should be addressed. And for the rest, the white paper is free of form.
But it is a basis also for civil liability.
Yeah, that's correct. That's also a really important point that is in this regulation. That if you are unfair or misinforming the public in your white paper, that's a ground for civil law liability, and that's a new and really important point from.
So some protection for the people.
Yeah, definitely. Yeah.
And Dion, how do you see that kind of the relevance of white paper success and data that we've seen in the past? Do you think because of this regulation, the form of these documents will change, or we can expect kind of different kind of correlations in the market, or will people still really go to kind of check the boxes, but still really try and go above and beyond to attract as many investors as they can?
What you currently see is that these white papers are already a success factor to do a successful ICO or STO. Yeah. There are several papers in the past, among which one that was in one of the earlier webinars by Dan Liebo, Thomas Lambert, and Peter Rosenbaum. So this is basically requiring something that was good to do to begin with.
Mm-hmm. It's good practice.
It's good practice, and it leads to further professionalization of the sector. So I think that is good. The fact that this now de facto becomes something close like a prospectus, because there's also civil liability attached to it, I think will lead to better white papers on the content side, more thorough white papers, but may also discourage some of the projects from even starting because of the.
But that's a good thing.
Because of the potential liability. Well, that depends on.
Well, you don't want. Yeah, I traveled the world, saw a lot of ICOs. There's a lot of.
Yeah, there's a lot of things that are not going well and maleficent projects going on, and I think it's a very good idea that is curbed. I do think. That on the positive side also some of the more risk-averse people getting into this might be a bit more reluctant.
Yeah, but you might argue that from Europe we will get quality white papers then, right?
Oh, absolutely.
Which might attract investors from Singapore and the Far East who are more prone into gambling, into good projects, right? And I for one, you were the captain of our own utility token white paper. Do you think we would have to rewrite our own white paper for the 2-token?
In our case, we were under that kind of €1 million goal, right? Which I believe allows us to make use of the most exemptions that are there, right? The lightest version.
Here as well.
Yeah, indeed. So for kind of the smaller projects or projects with a limited time span or very limited functionality, in our case that we really use for educational purposes, those things should not be stifled too much by things like MiCAr, right? But when we look at bigger projects or bigger raises, for example, with Dusk, we did our own raise a few years back. We might, under MiCAr, have needed to add or change certain sections or adhere to certain format requirements that back then we kind of got from the market and from our ambition to be kind of good citizens in the sector. But now this is a little bit more prescriptive, right? So this form of this document might change, and we don't know exactly yet what the kind of what the standard or what success will really look like. But it could be that they, because of MiCAr, become a little bit less commercially sexy documents, basically, which could impact some of these projects or deter them from starting. And also when we look at, coin market cap today, right? If we look at all the top 500 projects or something, maybe a lot of them probably didn't take the route that is now being prescribed, right? So exactly. Is there something said in MiCAr that these projects have to start taking these steps now kind of post a regulation, or are they all kind of exempt because of history, or
there's no it's not going back to the past.
Yeah.
So it's applicable to offerings that will start after that this regulation is in place.
But a lot of the household names might not even have been here now, or might not even have started under this.
So I have a question from the audience. Are you ready?
Of course.
Right. So questions are starting to flow in. From the question from Shimon, what does MiCAr regulation mean for a DEX like Uniswap? Who wants to take this question?
That's if the team behind this this DEX will aim at the EU market, then there's a couple of things that will hit them. Most prominent, that they will have to incorporate a legal entity in the EU and will have to be authorized by the local regulator.
Yeah, but this is a very interesting implication, right? Because because of how this law is set up, they assume that every project or every initiative has an entity in the European Union, basically, right? Yep. So when we look at Bitcoin, for example, the most prominent example, there's no legal entity. Obviously, we know the founder is anonymous. Now, because of the way they framed it, it kind of skirts the issue a little bit, right? Because it's only for service providers on top. But let's say the new Bitcoin has not been born yet, for example, or it's disrupted to a new form of the dominant decentralized currency without an entity behind it or anything like that. That kind of couldn't fly legally from here on out, right?
But even let's say that you have a DEX that is aiming for the European market, but is residing on the Cayman Islands or so. What would you do with regards to enforcement? I think that's difficult with the DEX.
Yeah, of course.
You can't easily take it offline.
No, you can't. You can't.
No,
not at all. No. Yeah. That should be an interesting question for MiCAR regulators to look at, right?
Yeah.
And same for the Bitcoin network or other networks that are fully decentralized. If there's a violation of these regulations, it's super hard to actually enforce.
Of course, yeah. Everything that's decentralized is really hard to tackle. But this is the first step from the regulator to bring this market into under regulation. So, of course, everything that's decentralized is the most difficult part of it. To jump on your point regarding Bitcoin, since there is no one offering doing an offering of Bitcoin, and mining is exempt from the regulation. So there is not, in the case of Bitcoin, not something really to point at that's falling under MiCAR, except of course for people providing services regarding Bitcoin. But services, exactly. Then you have persons or entity or companies that can be regulated.
So Jelle, the chosen one is asking a question here, which is
oh wow,
yeah, he's called the chosen
lucky
one.
To have him.
Thank you for your question, the chosen one. But the question is Bank Frick the only one who is able to at large scale do stablecoins in Europe, or are there other stablecoin projects that you know of? And I'm asking you this question because
yeah. So if they're the only one able to do stablecoins as an issue, yeah, so there's obviously a lot of stablecoins that have now some degree of market penetration in the European Union, right? So also Tether is being used, or Gemini or Pax, and these coins are active with European Union users. The interesting thing there is that they're often regulated or based outside of the European Union, which means that if they want to continue offering these services, if I understand it correctly, they will need to start adhering to these frameworks. So that could be a challenge, especially for the more decentrally governed of these projects as well, because they might not want to come under this regulation, and it might be very hard to enforce. If you're looking at banks offering stable coins, I do see them playing a clear role in other cash-like assets where they can act as an intermediary or as a provider, whether it be of e-money or whether they're an intermediary for CBDC. I'm not sure if... Well, they're definitely not the only one that can, but the devil's in the details a little bit. I'm wondering, and maybe one of you knows, is if what they are offering now, the way the question is framed, if that is a stable coin under MiCAR, so a significant asset reference token, or whether they're already doing kind of something else entirely. But there will be more parties that are allowed to do it. It's not just Frick.
I was surprised with the question. I don't think it's just Frick, right? There's other banks in Europe that are doing stablecoin projects. What do you know about that?
There are a lot of pilots, but I don't believe that they're a really large bank at this moment actually providing those free in the market already.
Yeah, and that's a big thing that we'll also touch upon later with CBDC is kind of what kind of level of market penetration the project has, right? Can it actually reach retailers and serve really as a cash replacement, or is it still kind of referencing some more centrally held asset? One thing that we've already touched upon quite liberally is the kind of the asset services and providers that are hit by MiCAR, so the CASPs, the CASPs. So the list is on the screen. I think we've probably hit most of them. But it'll be very much a layer 2 almost regulation.
Yeah. What you see here is that it's basically the same list as service provider under MiFID. With some additions to it, but that's basically one-on-one copy of the services.
Indeed. So MiCAR, I think if we can try to conclude it, it's definitely a first attempt, in my opinion, at cleaning up kind of the worst that the space has to offer. It doesn't fully tackle the kind of edge cases or the subtleties in that kind of better part of the market, so to say. But there they are relying on some initial good citizenship and self-regulation, right? These kind of things. But they're really trying to kind of first kind of clean the sector a bit.
Yeah, it's you have to keep in mind it's a first draft. As well as the first version of the regulation. So if you compare it with prospectus regulation, or if you compare it with market abuse regulation, both for financial instruments, that's much more elaborative. But it's a first step to bring this market under regulation as well.
So we can expect a lot more
in the future. Yeah, definitely.
This is only the beginning. One and kind of the second main thing that I think MiCAR will do in the European Union, and that's something that we'll touch upon in a minute, is the introduction of a lot more standardization. So we see obviously cleaning up the space and all these regulations popping up, but there's also a degree of common language that's being imposed, right? So this is how we classify certain crypto assets, and this is how we see them, this is what they start falling under, and this kind of common language has been a big kind of desire from the market, and now we're starting to get some of this, I guess, in a kind of top-down format, so we can start talking about the same kind of asset types, and that kind of leads us into our next talking point, which is the importance of standards. And there's a lot to be said about different elements. On a macro level, we're now seeing, MiCAR and MiFID for security tokens and all the crypto assets that we just mentioned, kind of capturing on the regulatory level quite a big chunk of things. And Dion, you had a great example earlier this week about the CDS industry and what standardization effectively meant there.
So in the early 2000s, there was a financial innovation called credit default swap. Credit default swap is essentially an insurance on a loan or a bond, usually referring a bond. Now, when this market was getting started, these are bilateral contracts, they're derivative contracts. Every contract looked different. And as a result, this market was not very liquid. There was not that much volume. People liked that they were able to insure their credit risk. Banks liked it. Also, the bank that I worked at the time, to reduce credit risk on their books. But from the legal side, from the paperwork side, it was a mess. And then ISDA introduced a template where you could tick boxes for a few standardized different flavors of a CDS contract. And all of a sudden, this market took off.
So before it was all different?
Before it was all fragmented.
On a case by case,
case by case, no standard documentation, no standard conditions, also no standard definition of what a default event was, and with the ISTA template, it was just a menu option where you could check whatever of the very few menu options you liked, and you had a relatively standard contract that you could relatively easily do, where also at the back end there was little further administration for these financial institutions.
Yeah, so practically speaking, in the market before that standardization, you could go to kind of any shop in the country or on the continent, and you get their interpretation of what the CDS is, of what they think is best practices. Obviously, you can already see where that would incur a lot of costs, right? When you're shopping
and disagreement
and
uncertainties.
Exactly, all these things that introduce cost into the market or that hamper adoption, and now effectively because of more top-down standardization, everybody will at least be offering in the core the same type of product or the same interpretation of asset classes, which is a kind of regulatory enabler for interoperability, for really adoption to take off, right? So you can go to any shop down the road and roughly get the same crypto asset interpretation in this case, or CDS in the
CDS case, it was an industry association, to the best of my recollection, that did it, not really a regulator. But
so from the market.
From the market,
Big difference indeed. One other standardization initiative that we see in the market is more practical. So this is also with relation to ITSA and IWA, parties that we work a lot with at 2Tokens, and they try to apply a lot more kind of practical frameworks that are not just regulatory, right? But they try to approach standardizations a little bit more holistically. So we have the example here. So the ITSA framework, for example, talks about also economic purpose, what industry tokens operate in. And the big thing that they do right is the ITIN classify the ITIN number. So it's kind of the token counterpart to the ISIN, the securities classifier. And their goal is to kind of from an administrative backend, so to say, capture all these different flavors, which are standard, so that people, by just looking at a code, basically know exactly what it is they're dealing with. And this is far more holistic. And what I even learned this week is that they're adding a MiCAr dimension to the framework. So they're adding the regulatory classification. So they're kind of going from the ETL, the economic, the tech, and the legal, and obviously legal skirts or overlaps with regulatory quite closely, but they're also adding that dimension.
You have ITSA in your show this evening.
Yeah. We have Stefan Schmidt from ITSA joining me tonight, where we'll be doing basically a brief version of some of the points that we're deep diving now. And he'll also be able to explain why they chose to add that kind of fourth dimension. And more importantly, which is also a question that I fronted him, is why do these frameworks still have a very good right to exist right now that the European Union is starting to impose their own frameworks? And there's a lot to be said for a more holistic approach in practice. So that's something that Stefan will be defending tonight. And what we also see is configurations within asset classes. So that's kind of, you know what the buckets are. We are now within a security token or within a utility token. What flavors do we have there? So probably the most famous example is the ERC standard for utility tokens, right, on Ethereum, where especially ERC20 garnered a lot of attention and adoption. But essentially, these smart contracts consist of, I don't know, let's say 40 options, and you can put the toggle left or you can put the toggle right and make a few decisions. And this configuration of these options, that's basically the standard, right? They've just proposed a way of setting the toggles, and then ERC20 really took off as the main utility token standard. But we'll deep dive a little bit later in, for example, what we're trying to do in the securities market, also trying to introduce standards like that. But to bring it all together, there's all these levels of standardization in different points in the market. And the big goal there is scalable adoption, basically, right? So it's not all a manual, very much fragmented effort every single time, because that's not how the market takes off. Time to go into our first use case to see if we can... Oh, I have a clicker malfunction.
There we go.
Yeah, so the European securities market. So Dion, this is really something that I would like to introduce together with you. So we see the security market today, and let's say I am a user and I want to purchase a stock in Philips, for example. What does that journey roughly look like for me?
Well, for you don't notice so much. You just call your broker, or you send in your order through your online broker. Yeah. And then you get a message back. Trade has been executed. But on that way, your transaction first goes to the broker, from the broker to a related affiliated institution, ends up at the exchange. At the exchange, a match for your order is being sought. That's work the exchange does. Yeah. Once a match is found, the exchange says, okay, here is a match. Now go make sure that ownership is transferred. Yeah. So it's forwarded in the process to clearing and settlement agents. Now these clearing and settlement agents need to call the bank to have the money transferred, need to call the custodian of the other party to have the asset transferred. This takes time. Yeah. In the meantime, things can go wrong. If I'm trading a security, in the meantime, I can go bankrupt. Yep. And then the counterparty to my trade has a problem. So also something needs to happen there. There needs to be some kind of insurance mechanism. We do that with a central counterparty that takes care of counterparty default risk, at least on regular exchanges, not in OTC derivative markets, or not necessarily in OTC derivative markets. That's quickly changing as well. And then 2 days later, in the end, 2 or 3 days later, in the end, the transaction takes place. So a lot of parties have been involved, and there's no immediate settlement. That takes time. So all the parties involved pocket a fee, which is costly. Yeah. And it takes time, which at a larger institution level also requires capital to be stored as a safety buffer. And that capital can't be used for anything, so that's also costly.
Yeah, because also, besides from default risk or really more bigger structural issues, there's also just the elapse of a few days in which something might happen to the relative cash position in the trade or the stock price, for example. And until this is fully settled, they have to make their own hedges on this.
So the central counterparty that assumes that that risk is in the meantime exposed to that risk. Yeah. Now, part of that central counterparty does a lot of trade, so part of that risk is just cancel out against one another. But there is some form of aggregate risk. Yeah. And that central counterparty needs to have a risk buffer to make sure that even in case of bad losses, it stays healthy and the market can continue operating. That capital buffer is money that's invested that can't be used for anything else. There's a so-called opportunity cost to it. So if we can get rid of this layer, if we can immediately settle, that frees up all that capital that can be put to better uses.
And reduces the cost.
And reduce the cost, obviously.
Yeah. And we see, and this is just on the trading side of things, right? So all these things have a role. So the broker is there because I cannot deal on an exchange directly. The exchange is there for the matchmaking. Well, that performs a clear market function, you could say. So there's something to be said for that. And the counterparty is a risk-induced cost, so to say. And then the CSD, where the assets lie, they take care of administration, right?
They take care of administration. They register ownership. They make sure that shareholders are invited to shareholder meetings. They're involved in corporate actions. They register
so that's a big thing,
splits,
right? So there's not even, so let's say my asset is not even trading, right? So I might be listed, but no trades are happening. I am the board or the cap table of a big company, a Philips or something equivalent, and I want to have all of my shareholders vote Now I have to go to the CSD, right? Because they're the only guys that know my admin.
Yeah. So they contact custodians or other admitted institutions where these securities are located. But keep in mind that especially for larger stocks, these securities can also be lent out.
Yeah.
And then it's often completely unclear where a security is lying. Tracing all that back can be a big mess.
Yeah, and obviously not free.
No, obviously not free. Now, this is with just one exchange. If securities were trading on multiple exchanges, then you have at different exchanges multiple parties involved. It becomes a bigger mess.
Yeah, so it can, if you're doing, let's say, only annual votes, then you see the current corporate action cycle where this stuff is started well ahead of time, right? Because we need to consolidate all of these people, yada yada.
And even
yada.
then it goes wrong at times.
Yeah, and this can have big impact, right? It can maybe turn a shareholder vote that's only marginally pointing one way, can maybe fraudulent, or well, not fraudulently, but erroneously go a certain way because parts weren't reached, or it can have some serious impact.
Or it is not clear who is allowed to vote. There are really serious issues that every now and then pop up with exactly these close votes. When some institutional parties have shorted and then positions is not clear who is exactly allowed to vote, because it was not entirely clear until weeks after who at which crucial time held the shares.
Yeah, exactly. And the same goes for people who are just in it for the money, so to say. So they might buy and hold certain assets for the expectation of a quarterly dividend, for example. But then the same reconciliation exercise needs to happen of, okay, who are all my shareholders and who gets to get paid, right?
Exactly.
And if I'm a long-time holder, then I will not be a big part of the problem. But there's also the classic examples of, so I'm buying one day before the dividend is due, then we have our T+2 settlement, right? And then, so I'm actually only the legal or economic owner of this asset after the dividend date. So how are these things priced in? And obviously this market has matured a lot, right? With that is taken into account, and that it's very clear towards users what they are buying, right? Are they buying with dividend pro rata, or are they buying excluded from the dividend cycle, or these kind of things? But it's all a very costly additional admin exercise because of this T+2 or T+3 settlement.
Absolutely.
So I have a question from the audience on this subject. And it is actually Sanchez is asking, do you have a recent example of a case where it was not clear who held voting rights at any point of time? Huh?
Not from the top of my head. Not from the top of my head, I'm sorry.
You know any examples?
No, it's tricky because only in the most extreme cases they tend to kind of reach the public eye, if you will. What we do see is the cost that is associated with this in the market. So when you see service providers, for example, that can do that share reconciliation for you and kind of take care of these voting rounds, if you will. There's companies that take care of sending out the agenda items and collecting the vote, and this typically racks up cost of around 20 to 25 euros per vote and per agenda item sent out. So if you're a very large company with a very large asset holder base, then this can rack up some significant cost every year, basically. And I think that kind of implies some of the importance or some of the issues or the impact that these errors can have, that there's such a kind of high willingness or maybe even mandate to pay for these things. But I will also have to look into a very recent example where this went wrong in the security space.
So there might have been these issues, but they are not revealed to the public domain.
Well, preferably not, right? Because then all the money that you just spent on getting this right will probably instantly be lost in your stock price going down or other unwanted side effects.
Thank you, Sanchez, for the question. Keep them coming, people.
Yeah, no, very good question.
Very good question.
So I think now would be a good time to see what aspects here we can start to potentially improve with tokenization. The whole goal of the overarching discussion is how tokenization in Europe's financial markets can be used, and then obviously what benefits does that bring. Maybe you want to start a little bit on what real-time settlement would do for the market?
Yeah, sure. So in the previous example, money and assets change hands only 2 days after the trade is agreed on. With the tokenization framework, you can get immediate settlement, which means that the moment you agree on a trade, so the exchange makes the match between your order and your counterparty's order, almost immediately or a few seconds, later, money, ideally in tokenized form, because that's easiest, and securities, also in tokenized form, change wallets. In that case, you don't have all that administration layer anymore. And in those 2 days, you don't have the counterparty default risk anymore. So there's hardly any need for a central counterparty anymore. That central counterparty you only need for a few seconds rather than a number of days.
Yeah, and when we start reaching the domain of seconds, then we can also start looking towards automated solutions for this, right? It doesn't necessarily need to be a market party. There can be some logic that takes care of this.
Absolutely.
So we're looking at exchanges where, for example, every user has a wallet, right? That's a big requirement to make it fly in a pretty way, in an elegant implementation. This kind of crossing of assets and cash called delivery versus payment, right? So that's that we cross my cash and your asset cross the bridge at the same time, if you will. We cut out the CCP, right? The central counterparty. A settlement is now instant, so this also frees up all that capital that you talked about earlier. I can now immediately start, for example, trading my asset again that I just bought, or start using the cash again that I just received. So there's all this kind of illiquidity, or this capital lockup is also reduced. Yeah. And when we talk about the example of having multiple exchanges, one of the big benefits that the blockchain can not only function as a settlement engine, but is also in its own right a register, right? A ledger.
Absolutely. One CSD will then be in control of that blockchain. And even if you want to trade the same security on a different exchange that has a different CSD, the first CSD will be the master CSD. Yeah. And the CSD of the second exchange will just be an admitted institution that has an account with that master CSD. And in that case, also trading assets across exchanges is now becomes relatively easy. If you want to do that in today's world, you would need about 10 days to transfer your assets from the one CSD to the other CSD, which is very impractical. That's why hardly anyone does it.
Totally free again, of course.
Yeah, totally free again. And with such a blockchain-based solution, you could almost do that instantly.
To swap from one chain to the other.
Yeah.
Yeah, or potentially you have two exchanges working
or maybe
on the same
even
chain.
on the same chain.
On the same chain, that'll be easier, right?
Ideally, aggregate to one CSD.
Aggregate to one CSD. That's what I meant, right? You have one master CSD, and the other CSD simply has an account with that CSD. And what is also nice, if you tokenize this, and this we have discussed in the next generation capital use case, and I think Dusk is also building infrastructure for that, or has built infrastructure for that, is that you can make these securities smart And because they're smart, you can save costs and provide better liquidity. So one example would be whitelisting.
Yeah.
Now there are a lot of costs made to make sure that the clients and the origin of the funds and securities of the clients are known to prevent terrorist financing, money laundering, etc. And also whether a product is suitable for a client. Well,
basically every broker has
every broker has to do that as part of the onboarding process. What the broker then can do is add a client to a whitelist for a certain security or security type, and then that onboarding doesn't have to happen again if that client wants to trade on the same security, for example, on a different exchange with a different broker.
Yeah, so then it becomes about standardization again, and if these exchanges agree on this level of KYC or customer due diligence, can start adopting each other's whitelist, so to say, and or share a whitelist, but indeed not repeat this onboarding cost every single time, which is a big deal for exchange because they typically bear that burden.
Yeah, and I think that standardization is really, really important here, because if you look at the regulation, at AML regulation now, that states that financial institutions can basically not trust others doing good customer due diligence, but have to do it themselves. And that's, but if market parties, together with regulators, can agree on a standard which can be audited as well by external parties, then you can cut out a lot of processes and also a lot of data processing with different parties. So customer experience is much better, but also cutting of costs as well as reduce a lot of data processing.
Yeah, so looking at that technologically, it would basically mean that when an asset is listed, for example, that could be a moment where a traditional amount of shares is captured in a smart contract. So that's something that the CSD could do, right? Launching or deploying your smart contract could potentially even constitute the commercial agreement you have with the CSD to kind of digitize this asset. And then this smart contract runs on a blockchain. And then users of exchanges will have wallets on this chain, which are related to their exchange accounts. And then they can have maybe in certain cases the same wallet on multiple exchanges depending on broker setup, or they have different wallets on multiple exchanges, but at least all this is happening on the same chain. So you can have your delivery versus payment happening on chain if there's also cash there.
You need tokenized cash.
And there's ways around it on the singular exchange level. They can deploy their kind of own on-chain cash, which only works in their part of the sector. But if you want to have tokenized cash that you can use in kind of all places, if you will, then you really need a cash equivalent or a stable coin that meets standards, etc. And we'll dive into that cash lag a little bit more later. And one of the also nice things that a blockchain does is that it's by definition reconciled, right? At least if done right. So when you look at stuff like corporate actions, I need to call a vote. Now I don't have a big issue in reconciling all my admitted institutions or brokers or this big custody chain, right? That can be 7 or 8 layers deep. I just know at every block in the chain exactly who my token holders are. And obviously it'll get a little bit more complicated when you start going into lending markets again, because this might occur off-chain again. But at least the basic custody chain, which is already quite a big step up from today's system, will be fully kind of real-time synchronized and insightful.
Real-time visible to the CSD.
Yeah, so if you want to call a shareholder vote, and it becomes very easy now to time this, I want to do this a few weeks from now, and if this blockchain has a stable kind of block time, if you will, then what you do technologically is that you pick a block height, for example, when this vote occurs, and before that time, well, even you can have anyone vote, but at that time the chain decides who was eligible. These are the guys at this point in time that actually have assets that have been settled and cleared, and you could have even bought in the block previously, right? And your vote is eligible, and it's done and dusted, basically. Same way vice versa with dividends. You can just push it out. I want to, at that point in time, I have 100 million euros in profits. I see an X amount of token holders. I want to push this out pro rata next week at 12. And you can let your smart contract take care of that. becomes a lot sexier to do all this admin stuff.
And blockchain-based infrastructure is also very well suited for secure voting and for easy delivering of voting rights. No mess with votes sent in by mail or that get lost.
Right, we're touching on that one, the balloting.
That was actually one of the questions in the earlier session on the token roadmap, voting, and how voting for tokens, how that might, be regulated going forward.
Obviously, it has some initial drawbacks. So one of the big things that it'll be very good at is predefined voting restrictions. So we have a proposal, and you can do yes, no, or blank. On the fly amendments and stuff like that will need a little work, right? Because things get tricky. That's something that a physical shareholder meeting can do for all its other DeFi or deficits. So there will have to mature over time things like appeals procedures or how to make changes. But for basic voting, which is your kind of classic 80% parity, it'll work extremely well already in a basic form. So very definitely a lot to be gained. I want to talk briefly about, we talked about technological standards earlier. I want to very briefly dive into, okay, so we have this smart contract, right, that constitutes an asset on a blockchain. And this is kind of my part of the space. What kind of thinking goes into that, or how do you then digitize or tokenize a security, right? So I've brought a very simple example, and we'll fold out a few additional pictures in a minute of our confidential security token standard, XSC. And there's a few big themes that we can discuss in that context of all the kind of things that are relevant to make a compliant security token. Smart contract management is a big one, so that in its simplest form, for example, states who is allowed to make more securities. So you cannot have this free-for-all on-chain smart contract where there's there needs to be trust, right? Because there's now a certain degree of centralization or decentralization, and you as a user want to be able to see, okay, so what is a minting procedure, for example, right? How can this company make more shares? Obviously a very big one.
Dilution.
No unexpected dilutions, no, indeed. Roles, access control, whitelist management. So that's very much things like, okay, I am the owner of this company, I'm the issuer. Maybe the CSD is allowed to do certain things. Maybe I want to give a regulator a view access, for example, because all the things that we talked about, the value chain earlier, it kind of has a similar value chain for reporting, right? It's all also from the bottom, from the broker to the institution, reporting to all, typically even individually, to their local regulator. And this can all be reconciled now, right? Because they can just have direct access to a full trade log, for example, or insight into the whitelist. That requires a little bit more change management, but it's technologically there, right? We talked about voting, dividends, and an important one that I want to discuss a little bit with you, Willem-Jan, is confidential settlement. So there's a few legalities tied into what constitutes a legal trade, right? So security in its most basic form is a share or a bond, for example. What do you mean
confidential settlements? Anonymous settlements, or?
Mainly confidential for onlookers. Oh. So what you see is in a decentralized infrastructure, like for example Ethereum, you have your block explorer, right? And you can kind of technically see anything that's going on the network. Yeah.
So from a market abuse perspective, that's really a problem. If you can see every transaction, then you can have also inside information regarding trading.
That's right.
Yeah, and I can, if I know because I've done a trade with you, I might know your wallet address, so I can see your other holdings, right? And this might not be a big issue for us as colleagues or friends, but when you look on a market level and there's institutions moving into the space that have certain trade secrecy, or they want to not share what kind of holdings they're entering into, that's a big issue, right? And a very good example that we saw in crypto is that first we saw, for example, a very big owner of Bitcoin moving a big position from their wallet to the exchange, and then people would freak out, right? Oh, someone's about to sell 100,000 Bitcoin. I need to get ahead of this. I need to start selling. So then the price would slip for the big VC, for example. But then once they started to know that trick, you open a short position and then you just move your assets. Now the price dips because everyone's scared. You cash in the short and you just move it back again. So you start to see all this cowboy manipulation that stems from everyone being able to be an onlooker on the chain, right? So you don't want full anonymity, because the for example, the company that you're trading or the exchange or the regulator, they need to be able to see or at least verify what's going on, but you want onlooker confidentiality. So the random guy next door shouldn't be able to see what I'm doing, right? Because that opens up this world of pain that we just touched upon.
Yeah, and total privacy is obviously the other side of the medal, and that wouldn't work in current regulation as well, because you won't be able to perform transaction monitoring as a company and report to the regulator as well as sanctions regulations that are in place in all EU countries. Yeah. So as a company and as a exchange, you wouldn't be able to comply to those regulations.
Yeah, and there's also very practical stuff like tax regulations, stuff like that. Even if we are both whitelisted, we're both allowed into the party, we've passed the KYC, etc. I still cannot sell you 1 million Shell shares for €1, and because it's fully anonymous, hey, look at what we just did, right? And we're just going to skip all proper legalities.
How would that work? I mean, those you can always look up into the chains, right? You can see all the blocks. Would you have to obfuscate?
Yeah, so basically the way that we design it is we use what's called as a zero knowledge proof, which is a way of proving to, for example, onlookers or other parties on the chain that a certain data point. So this can pertain to your identity or to the transaction that you just did without actually revealing something about what that information is. So this allows you to prove to the outside that what you're doing is, well, secure or valid, you name it, but they don't get to see the actual contents of what you're doing. And then depending on other parties in that ecosystem, you can choose to reveal more. So for example, as a user, I might want to reveal more, or as an exchange, I want to be able to maybe see more. And you can even make this a prerequisite requirement. For example, this visibility for making an account on your platform, because they have to comply to regulations, etc. But in the OTC market, you probably don't want any of that, right? You just want to comply with regulations and let me do my thing. No, my neighbor doesn't need to know that I had a nice windfall this week, or it's none of their business. But that settlement thing, that's a technically a very big difference compared to a utility token trading and settlement. So maybe you can introduce a little bit about what constitutes a legal trade, if you will, and I can share a little bit on what that meant technically.
Yeah, if you want to sell a share, then you cannot just airdrop those shares to someone. There needs to be an agreement in place for it to work from a legal perspective. So you always need an offer and an acceptance of that offer from both parties. So that can be tough if you look at normal markets and normal blockchains, how they constitute technologically. So we've been through that quite extensively, how it works and how to tackle that.
Yeah, so what you see in the traditional transaction models, right, UTXO or account-based, I won't go into the details, is you can liken them to, for example, the IBAN network, where I am allowed to send you, Dion, €10, and you don't need to necessarily approve that transaction, or we don't need to explicitly agree that this transaction is taking place, right? And that's the same with these kind of two predominant schools of account model in crypto and blockchain today, that I can send you Bitcoin or I can send you Ether, and we don't need that kind of mutual acceptance of it. But with securities, like you just explained, this doesn't really work because they might have certain rights or even obligations attached to them.
For instance, if you don't want to be airdropped the shares of a bankrupt company or shares which have obligations that have not been met by the former shareholder, or even be airdropped shares of a company that's in being accused of fraud, or
if you have a 4.99% stake as a hedge fund. You get shares dropped that push you above the regulatory hurdle.
Yeah, for instance, natural persons as well, from a tax perspective.
Yeah, so there's all kinds of reasons why that didn't work for us. So we had to create what we call Zedger, which is basically a new kind of transaction model, that if you are not transacting the dusk currency or the coin, because those are not securities, right? But if you're transacting the XSC standard, which is kind of our ERC20 equivalent for securities, then you need to make use of this transaction model because we need to avoid all these kind of legalities, and that pertains to ownership tiers and like you say, all kinds of implications that ownership of shares could come with, right? And this is also how we can guarantee this DVP, this delivery versus payment, because Zedger makes sure that these two things cross the bridge at the same time, because otherwise you would still have this real-time settlement issue where I would send you shares, and if you delay in sending me back cash, for example, because they're separate transactions, then it doesn't work. Then we might have to do that through a smart contract, which could be annoying again or add some cost. And now the transaction model by nature has this bilateral functionality. So it's always real-time DVP, if you will, delivery versus payment. So this really takes care of that security side, that asset side, and we've alluded to all kinds of things on the cash side, but I think that's a good segue into our next use case, which is the central bank digital currency. So we've talked about multiple potential on-chain implementations of cash, stable coins or e-money, but a big one now, where there's also a 2Tokens working group for, is central bank digital currency. And basically what central bank digital currency, CBDC for short, is money issued by a central bank, accessible to households and businesses. That's the way it was put last year, but it's digital, right? So it can be on-chain in the desired implementation that we just discussed, but in essence, it's just purely digital. And the thing that makes this interesting for us today is that in April, the Dutch central bank posted a paper that said that they wanted to pioneer this movement for the Eurozone. So they said once there is a Eurozone level clarity on this topic, we want to be the sandbox or the trailblazers or the what have yous, right? And probably a good first question is, would this fit the way we currently view cash, Willem-Jan? Is this a whole new beast, or is it just a digital wrapper around the cash that we've all come to know and love?
Yeah, it's actually central bank currency. So it's not an IOU from a bank. It's not a claim of you on a bank that can go exactly can go bankrupt, but it is actually the digital equivalent of the banknote.
Okay.
But it's less anonymous.
Depends on the implementation, of course.
On the implementation, but typically it will be.
Typically, definitely, yeah.
No, indeed, and this paper stated there's a great many kind of design possibilities, right? And you're already now putting your finger on one of these things or one of these spectra that need to be crystallized. And I brought two with me today to briefly discuss. So the first one is very much about the technical possibilities. So there's this spectrum of design where they're thinking, okay, does this simply just need to be a digital version of the banknote? Or do we want to already go more complex from day one, where we build a certain smart contracts platform where you can already embed logic, right? When I get my salary, I pay rent, or that can be a very basic if this then that type implementation, but can also be used for more. And the big question is there, okay, how complex does it need to become for us, right? Like, do we just issue a very robust digital euro? Or do we also need to start basically maintaining an app store around it, if you will, with functionalities and stuff that people need in order for relevant use? Or may appreciate. And this was a...
Yeah, the question that was asked is, why do you need a CBDC for that? Some of that functionality that you just mentioned could also be done by BSD2 API calls, right? So
So that was a big thing around how do we issue this? So do we just take it as a central bank liability on the balance sheet, and people can just intermediaries can hold positions with us and let the market build all this functionality, or should we do more of this? And that's kind of already segueing a little bit into the second one, which is around ownership. So is it something, is CBDC?
Can I quickly follow up on Alex's question? I think an important trigger in this whole CBDC discussion was Facebook's plan to introduce the Libra coin. There's a recent study from, among others, Harold Ulick, from University of Chicago that basically argues that if we get such a world currency that really fulfills the function of medium of payment and convenient medium of payment. So before we had the gold standard, but nobody would take a brick of gold to a car dealer to buy a car. But with Libra, you could, at least the way it was initially meant, you could do that. And that paper shows that if you get something like that at really a global scale, then central banks may lose a lot of flexibility or their complete power in monetary policy. Yeah. So they want to prevent that. They want to front run this. And they're kind of nicely doing that by working on CBDC. And at the same time, there's this regulation that also put constraints on what initiatives like Libra could do. They would become significant, which would entail extra regulation. So this kind of buys central banks time to come with a competitive alternative.
Yeah, it's like a bipolar Jekyll and Hyde type.
And in that study from University of Chicago, it's really the convenience of using it as a means of transactions is really crucial. And that convenience could involve some of the additional functionality in smart contracts. So also for that reason, this is actually an important aspect to take into account in these discussions.
Mm-hmm. Yeah, and that convenience is a very big point, because if this is created and it's technologically convenient, but by law I can only get it, for example, via an intermediary, then me as a retailer might not be able to experience that convenience, right? Or at least there might be costs incurred with it. It's one of the big things that we see in the discussion now. Should a retailer be able to have direct access in a wallet, for example, to an amount of CBDC, which...
What do you mean by the retailer there? Is that just
me as a natural person? Just a retail user.
But we seem to have, tipped on an interesting subject because we have questions from the audience. And one question is from the chosen one. Thank you, chosen one. Is there any DLT available out there today to do the same amount of transactions, that SEPA does, that you know of?
So what we see in pure on-chain transactions, so there's a lot of implementations that work, for example, with sidechains, or if they've got kind of technological implementations that deal with that, probably would not directly compete with the entire SEPA or Visa network, right? These are the typical examples. The implication underlying that question is that there will be kind of one chain that take care of all the CBDC transactions, and that's not where reality is going to, because what we see is that if you, for example, in this ownership spectrum, go the route of intermediaries, then what you might have is you have a central bank, and they might have a chain with intermediaries, right? Just big CBDC positions where they do their bookkeeping. And then every intermediary, for example, might use CBDC for their own use case. So one could be a retail payment system. They would need a huge amount of throughput. One could be, for example, to provide on-chain cash for securities trading, what we've been talking about. They would need a severely reduced throughput, because it's not even comparable, the amount of transactions you get, right? One could be, I don't know, trying to replace the bookable, or all different types of use cases, and they have their own kind of TPS requirements, if you will, right? So no, but I also don't think that the European Central Bank will want to operate their main admin on a chain that will also have retail users on it for their own sake, because they'll feel responsible for it and need to do upkeep and keep it robust. So
there will be side chains.
Yeah, there will be probably many chains. And the question is whether that's a good thing, because these intermediaries, they will potentially add cost, right? So if I want a CBDC issued on Dusk for on-chain delivery versus payment, securities trading, then the implication could be that I have to go to an e-money provider, for example, that can hold an amount of CBDC, and they put the same amount of CBDC in a smart contract on my blockchain. And if there's a cost associated with that, then who's going to bear that, right? Because these things always need to run on par, one-on-one. It can't be the case that suddenly it's 0.9 on-chain CBDC equals 1 on the balance sheet, because that's where all kinds of weird things start to occur. So the question is no, but I don't think it will matter for implementation on the short term. Also, these guys are kind of working to a 2024 calendar where there will be a lot more advances already technologically, but I don't think it will necessarily need to compete with SEPA. Definitely not to be useful initially, and maybe it will never actually need to hit that kind of throughput. But now we're already touching on kind of some of the base pillars that we saw. So we just talked about the Dutch stance, so there's 2 design decisions, right? But now the European Central Bank workforce actually posted an update on CBDC last week. And this first one is exactly what that question also just touched upon, right? So it always needs to be convertible at par. So
well, that's also a question from Bas out there. How do you see commercial? But you kind of answered that. How would commercial banks play with CBDC, and how would you protect banks against a bank run, right? But if that's interesting.
In particular, in a crisis, that would be a problem, right? So you can get all kind of provisions that make it unattractive to hold CBDC. You could, after a certain hurdle, have negative interest rates or so to do that. But if you can have really an account with the central bank, and like in 2008, 2009, banks really get into trouble, and you also saw it in Greece and Cyprus. There you had a massive run on the banks because they didn't trust that their country would stay in the Eurozone. And in Cyprus, actually, depositors lost some of their deposits. They would want to run and store their money with the ECB.
Very interesting question. Thank you, Bas. And
and it ties very well into the first and the third principle that we see here, right? So it needs to be a European solution, needs to be widely accessible, but it always needs to convert at par. So it means that if we have to go through intermediaries, then there will be friction there. There will be cost associated with it. So how do we keep it at par? Well, these costs need to go somewhere. So is that the user or the intermediary, or somewhere this cost will sit, and that is what I see as a big challenge for adoption, because this needs to become an attractive thing in order to actually defend against the Libras or the bank runs or you name it. And so then the question is this intermediation good enough? Because I might not want to go that route if it's so expensive, and then there's no adoption, and then there's no reason for doing it, right? And you also, Dion, I think pointed out there's a kind of inherent contradiction between the fourth and the fifth principle, I believe. Or was that you, Willem-Jan? So we have this market neutrality, so we don't want to crowd out private solution, but we also really want this trust by end users. So if this becomes a richer ecosystem, does that trust dilute?
That is what I just referred to, right? Especially in a crisis, there's nothing that will be trusted like this European Central Bank. Just look at the COVID pandemic at gold. Right? Yeah. Gold has been skyrocketing over the past months. Yeah. In a crisis, people put their money in safe stuff.
Yeah, no, indeed. And that's also where they said that in a scenario of end users being able to hold CBDC, there will be these disincentive tiers, right? To also make things like this less attractive.
But that disincentive needs to be pretty strong to also cover crisis.
Yeah, no, fully agree, because otherwise you're happy to take the discount or pay the premium, depending on how you frame it, for safety, basically.
That in the DNB draft, that's really one topic that's discussed quite thoroughly, and they also say the possibility is to just maximize it.
Yeah, the limit is also, in my idea,
a hard cap.
A hard cap. Yeah, the only.
And that would hurt stuff like securities trading, right? Like if you want it as a payment alternative, then a hard cap of, I believe, 8,000 euros they mentioned in the design paper, that's fine. That's probably for most people a very comfortable amount for any kind of daily or monthly business. But if you want to use it for buying stocks as well as an on-chain alternative, then that might be a very troublesome cap, right? Because 8,000 euros will definitely not fly for the bigger fish or even big angel investors. There were two very interesting takeaways for me in this update that was released last week. So the first one being that CBDC is not a crypto asset or stable coin. So this really in their mind puts it in a different category, right? It's cash. So this is not a Tether or this is not a Libra, which is also what they're kind of playing defense and a bit of offense against.
Central bank money.
It's real central bank money. So it's our liability at all times. So this means that the promissory note that the banknote represents, this is that thing but digital, right? It's our responsibility to, if you via whatever route end up at our door with this thing, you get the money for it. And there's all kinds of ideological debates here because people are, you mentioned the gold standard, this puts it back on the balance sheet, there's gonna be more fractional reserve shenanigans and all this other stuff, right? It's just more liabilities. Shouldn't we make this something more inflation resistant, or a big ideological debate? Not really something we'll be going into today, but I think it's very interesting that this digital alternative will be an official liability of central banks, and this will also be interesting for the Dutch position. So they want to be a front runner, but it won't in its source be their liability, right? It'll be a European level liability. So they need to come up with something really good, because otherwise why would all these other countries have accounts with the Dutch central bank if the actual liability lies with the Eurozone, right? Like, cool that you want to front run this, but we're just going straight to Europe, all of us, all the countries directly, or there might not be a good reason for it. The second one, and that really was more important for my part of the scene again, is that the Euro system said they would study whether balances in the distributed infrastructure would form a part of monetary base. So what I just described is, if I want CBDC on a blockchain, I might need to go to an intermediary, and then it's officially kind of an e-money token or something like that. They do it for me, but they've now kind of underwritten that there will be a need for CBDC for all kinds of on-chain transactions. So there might be a subset of this total amount of CBDC that people will want to put on the big blockchains, right? And they're now looking into whether that kind of deployment of CBDC, so fragmented deployment on different chains, would still constitute part of the monetary base. So this means that it would not be an e-money token via an intermediary, but they will acknowledge, for example, we're putting 10 million CBDC on the Ethereum blockchain, or on this or on that. Might not be the strongest example, but conceptually I think it's clear, and we would still recognize that as part of our monetary base. And I think that will be a very, very interesting one to watch, because that could be a very progressive stance if they say that that is the case.
So Dion, a question from the audience, I give it to you. So if there are so limited users of CBDC, right? So who's going to drive innovation? You know, where's that coming from? From the central banks or from the industry?
Or from the service providers.
Do you think? If there's so limited users, you know, why would you?
Well, it very much depends on how exactly this is going to be designed, right? In principle, there's great appeal, so you have potentially a lot of users, because everyone likes to have something that's super safe, much safer than what we have with banks. The problem is that you can't have that for many reasons. Technologically, central bank can't do that. It interferes with their other policy objectives. You kill the financial sector, which has a whole range of other problems. So they need to find a good intermediary solution to that. But because fundamentally CBDC would be very appealing, also services on it probably would be well appreciated.
We would need a good crisis, worldwide global crisis.
I think crisis could actually give problems.
Never waste a good crisis.
Never waste a good crisis. I absolutely agree. But when you get crisis, everyone would want to really go to the central bank directly, and I think that's actually what you don't want. Because that compromises the survival probability of financial institutions that in the end need to drive that innovation.
Very strong point. We're going into our last stretch. What we've talked about is tokenization in the European financial market. So we touched upon regulation, but also on technology, on practical implementations. And the main two use cases to kind of bring it together are, we looked at the securities market, so how can we tokenize assets and what are the wider benefits there? And we also looked at cash, right? So how can we tokenize cash and what are the wider benefits or subcurrents that are running there? And that we kind of need both in order to really start shaking stuff up in the system the way it is and to start realizing some of these benefits, especially on a European level. There can be value in pockets with just one of the two, but if you want it to really fly, then you need both, and yeah, explained hopefully by relatively concrete examples. So to bring it all together, maybe the first point for you, Willem-Jan, the regulatory landscape. Yeah, where is it headed? What's the TLDR?
We're going to see a regulation that is really broad from perspective what it covers, as well as substantively what it entails. So it covers all crypto assets, and it is a framework for both white papers, service providers, and market abuse.
Yeah, so very, very wide. Maybe Dion on the use cases side. So we talked about cash, assets, standards. Any last words in that regard?
Well, I just hope that either a very widely adopted stablecoin or a CBDC with a good on-chain implementation and good interoperability features will be introduced that would really serve as an enabler for the rest of the ecosystem to very efficiently do transactions and make this grow. Good APIs or standards would facilitate that.
I fully subscribe to that notion.
Yeah, the last question is from the audience.
Of course, the last question.
And you need to answer it, and you have less than a minute. Why is it such a big deal that the DNB supports us by hosting a bank account?
Sorry?
Why? Could you elaborate on the DNB support Dusk by hosting a bank account? Why is this such a big deal?
You mean in the e-money implementation? Now, so what would happen there if I want to, as having created the Dusk network, that the users of this blockchain have access to the most reputable on-chain cash, right? That's always a great ambition. So, but if that comes with a very high cost in order to implement, then for the users, they might say, no, give us a Tether or give us Libra, because I don't want to pay for that, because this works just as well, and I don't care that it's maybe less reputable, because I'm going to be trading within seconds, and it's fine, right? It's not my problem. But it's not really where you might want to go as a chain, right? Because we're seeing all this regulation is increasing. You want it to be a viable solution in the financial markets. So you would love to offer the best, the most reputable option out there. But it's also their responsibility to make themselves competitive, because there's a acceptable cost for compliance, obviously, and if it's mandatory, then sure, but if it's in a more a gray area, or if it's more up to the users, because ultimately it will be decentralized, then you do want to be also competitive by nature, right? So that's why that's a problem, because I don't always call those shots, right? And I will increasingly or decreasingly call those shots. So that's why you want it. Yeah, ideally they just make the best thing out there, and then adoption will fly naturally for them. We discussed a lot today.
We're over time.
We're a little over time, but just a minute. So thanks everyone. Thanks Alex for moderating and picking out all the good questions. Dion, thank you for being here. Willem-Jan as well. Alex and myself will be back later tonight in the kind of grand finale of the last 2Tokens initiative year at the summit. And I think we will be wrapping up for today, right?
Yeah, and if you didn't register for tonight, be sure to go to the website, and because there's still seats left. Very online, good. Of course. So, and I guess my key takeaway is that for this first version of the token roadmap that we published today, we're going to need at least another version that adheres to MiCAr. Thank you all for zooming in, and we'll see you all tonight.
Thanks, everyone. Bye-bye.
Thank you.